Bloomberg Audio Studios.
Podcasts, radio, news.
This is the Bloomberg Daybreak Asia podcast. I'm Doug Krisner. You can join Brian Curtis and myself for the stories making news and moving markets in the APAC region. You can subscribe to the show anywhere you get your podcast and always on Bloomberg Radio, the Bloomberg Terminal, and the Bloomberg Business app. Let's take a closer look at one of our top stories in a little greater detail. President Biden preparing to block Nippon Steel's takeover of U.S. Steel. I spoke earlier with Josh Wingrove, Bloomberg White House reporter, and I began by asking Josh for the latest on this evolving story.
This has been a long-running saga, this deal, $14.1 billion deal announced in December. Biden has been on record for some time opposed to it, as has Donald Trump and as of a few days ago, Kamala Harris. But the question has been sort of like, why hasn't anything happened then? You know, it's been sort of hanging in the air. And so the development here is that our reporting is that that Biden will kill this deal once it gets to his desk from the security review, a process known as the CFIUS process. This is normally reserved for like adversarial nations, at least from America's perspective, usually China, almost always China. It's really unusual to have it aimed at a deal like this one involving a Japanese company, obviously an allied country of the U.S. So there's just a lot of uncharted water factor here. So right now, everyone is just sort of waiting to see what happens. If Biden tries to kill this deal, U.S. Steel is pledging to use every legal tool it can. In other words, Biden killing it might not necessarily mean it dying. It could more accurately mean Biden trying to kill it and triggering some sort of legal fight. It's worth backing up a bit here and just saying the proponents of this deal say, hey, China is using steel as a cudgel, bullying people, dumping steel in their economies. This deal would make a large company with American and Japanese assets primarily that could compete with China, or at least have the scale to compete with China. Critics of this deal have pointed to the lack of guarantees, or what they say are lack of guarantees for union workers in Pennsylvania, which also just happens to be one of the top electoral battlegrounds in this year's election, if not the top electoral battleground, not to mention the state where Joe Biden was born. So there's a lot of moving parts on this one, but it looks like Biden's going to try to kill it.
Yeah, that's a very important piece of context. You know, I was struck, Josh, by the piece in the Wall Street Journal quoting the CEO of U.S. Steel, David Burritt, saying that if this deal were to fall apart, U.S. Steel would then close mills and move its headquarters out of Pittsburgh. Do you think that's going to carry any sway here?
They certainly are hoping it is. And there's been this kind of drumbeat of what you might call last-ditch efforts from proponents of the deal. Remember, both U.S. Steel and its buyer, Nippon Steel, want this deal. The people that are opposed are led by the union, as well as lawmakers, including the senators in the state and others, most notably the president, who's preparing to take action on this. And so you had that statement. You also had Nippon Steel say, hey, we're going to give a majority American board to the company that would come of this, sort of a proxy board. In other words, that is the thing that normally CFIUS has to really twist companies' arms to do. They went ahead and voluntarily did it in what looks like an attempt to sort of head off a question about that. And so there have been some other things that have been sort of dripping out, including a most recent commitment of an additional $1.3 billion that they would spend on top of the previous commitments they had made. So they've been sort of, emptying out the apple cart with everything they have to offer in a bid to at least try to get an outcome they want, or at least change the narrative around it. And right now, if this deal does die, and again, there's no way to tell for sure whether that'll be the case, but if this deal does die, then the question is, what happens now to U.S. Steel? It's a sort of fabled American company, but it's not at the top of its arc in terms of, financial stability, employment numbers, all that. There's a real risk. It's not just U.S. U.S. Steel sort of blowing smoke. There is a real risk that some of these plants, particularly these union plants, which are the older plants, the ones that need the most investment, the least profitable ones probably in some cases, real question of what happens to them if the Japanese don't buy them.
Well, to that point, I was reading an interview with the CEO of U.S. Steel, David Burritt, and he was saying that the company needs to spend roughly $3 billion in capital to modernize these facilities as a way of becoming more competitive on the global market. Has there been any conversation from the government saying, we would provide this money to help you if we undo this deal? Has there been that part of the discussion unfolding?
There hasn't, but that would be one potential shoe to drop were this to happen. It would depend on Congress. It would depend on a lot of things. There's bipartisan agreement on this a little bit. I don't know that it would have necessarily the steam. I would just be straight speculating, which I try to avoid doing every once in a while. But yes, that is an option. Like if this deal falls apart and Nippon Steel U.S. Steel is sort of teetering, and a bunch of steel workers, in a crucial battleground state are about to be thrown out of work. Yeah, I expect there at least to be a conversation about what, if anything, the government could do. They just haven't gotten there right now. The question also is, can you split this company up? That might be another one that surfaces.
He is Josh Wingrove, Bloomberg White House reporter, joining me earlier from the nation's capital, helping us understand a little bit better what's going on with what we are told would be a move by President Biden to block Nippon Steel's takeover of U.S. Steel. Let's get to market action with our guest, Rasid, global market strategist at JPMorgan, joining us from the Lion City of Singapore. Rasid, good of you to make time to chat with us. I think it's really about Fed policy at this point with weak reading on job openings. Right now, I think the bond market is speculating a bit as to whether or not we could get not a 25 basis point rate cut this month, but maybe something in the neighborhood of 50% or 50 basis points. What do you think?
Yeah, no, thanks for having me and good morning. So just looking back at the JOLTS report, I think it is consistent with the previous data that we see. Number one, it does show a labor market that is cooling. And secondly, the reassurance that it is indeed cooling, but not breaking. So, when we look at the ratio of openings to unemployment, for example, unemployed workers, that really allay fear of ongoing labor market tightness. Layoffs are still very low. They're showing no signs of trending upwards as well. So the insufficient layoffs, it really echoes what Jerome Powell had said at the Jackson Hole as keynote speech as well, that really the labor market is indeed cooling, but not necessarily breaking. To your point about the Fed, they are ready to cut rates as pressure, on inflation have been put to rest. The magnitude, however, really depends on the August employment report tomorrow. For us, we do expect a 25 basis point cut, and that really is a reflection that we don't see major imbalances right now. And the pickup with unemployment really reflects a labor supply story rather than a labor demand story.
Tomorrow, your time, that would be Friday U.S. when we get government's data on August payrolls. Let's turn a little bit to the reaction that we're seeing in the foreign exchange today with those lower treasury yields. We've got a weaker dollar, but boy, I was just stunned by the rally in the Japanese yen. We're at 143.45. There's been so much volatility right now in the foreign exchange, particularly where the yen is concerned. How much of this has to do with expectations that the BOJ is going to be perhaps raising interest rates between now and the end of the year?
Yeah, no, good question. So when it comes to Japan, when you just look at the domestic story with the inflation prints that we have seen in the past week, for example, we are seeing that wage price spiral that the Bank of Japan is looking for seems to be intact. So the expectation that the BOJ will continue to, hike rates sometime later this year is pretty much intact. But again, the Bank of Japan is a very gradualist central bank. So the magnitude of hikes will not necessarily be in traditional sense of the 25 clips that we see for other central banks. But I think the way that we look at Japan, especially the case of investing, longer term, the fundamentals are still pretty much in place. So while the stronger yen could weigh on earning outlook, the long-term factors, corporate governance, the fact that the domestic story has really picked up and turned a corner, that to us could really support Japanese equities, at least in the longer term.
Raisah, what does this stronger yen mean for corporate Japan? I mean, there's a case to be made that this is going to harm the exporters. Is that necessarily the case?
Yeah, so I think in the short term, that's the expectation that it could weigh on earning outlook. But if we do see the corporates in Japan for the second quarter, they were able to expand margins. They did benefit from the currency depreciation that we saw. So if we do see the inverse happening, i.e., the stronger yen, it could, affect the earning outlook, especially for the for foreigners, the foreign exporters as well. But we do see that the linkages between the stronger yen as well as the Japanese equities performance, that correlation has somewhat broken in the last couple of years. So we do, hope to shift the conversation away from that correlation to more a longer-term fundamental factors that were, I mentioned earlier.
We've had a number of conversations on this show when you consider the fact that Japan is a big exporter of goods, not just to the United States, but to China as well. And with slow growth in China, that may be in turn harming some of the big exporters in Japan. Is that the way you see it?
So the way that we look at it is ultimately the linkages between, as you mentioned, the U.S. As to Japan. And we did see, a couple of Mondays ago where we did see negative data that came out of the U.S. and how it did trigger, for example, movements in Japan as well. And it really reflects that at the end of the day, the final demand story is very key, not only for Japan, but as well as all the other exporters out here in Asia, which includes your Korea, Taiwan, and even in Southeast Asia. So I think, the way that we look at it is we are seeing and gauging the corporate behavior in the U.S. as a barometer of how the export performance will be more so in Asia going forward.
What about the China story and the weak economic performance in China and how that may be a drag for some of the companies in Japan?
Yeah, so, when we think about China specifically, it's, what we're thinking is more is needed, right? We do expect, we actually want to see additional fiscal support, for example, from central governments. We would like to see larger rate cuts and a more comprehensive housing stabilization plan. So to the extent that, China policymakers really, focus on this, then we could see some recovery in China and we could see a bottoming, or at least in the bottoming of the demand. And that could really trigger at least some recovery in other parts of the market, and that includes Japan as well. But right now, we do see the manufacturing numbers that are coming out of China. They don't look very constructive at this point. So we do think that a lot of it is still needed. But for the Japanese story in particular, we do think that the U.S. Backdrop is really more critical to the whole story.
I'm struck by the fact that China's been struggling for such a long time, and there is this issue of overcapacity when it comes to the manufacturing side. Do you think that's going to be resolved anytime soon, maybe by some consolidation that takes place in certain industries like electric vehicles?
No, that's a good question. And, when we look at electric vehicles, and we do think that that's the glimmer of hope for China, right? Because, we did see the retail sales number recovering slightly, but the underlying trend is still very weak. We do expect investors to really still remain very defensive in the near term. So the strategy in China, for example, is really tilting towards the high dividend companies, state-owned defensive sectors. So I think that really hasn't changed. When it comes to EVs, though, I think something to also note is that the EV domestic market, i.e. that once you have that overcapacity, oversupply, the bulk of EV market actually is a more domestic story as well. So I think that's something to note. So yes, there's all this noise around tariffs, etc. But the demand for electric vehicles within China is also going to be key to addressing whether China solves the overcapacity story.
What about the issue of potential trade wars getting a lot worse? We touched on the EV tariff part of the equation, this tit for tat between countries like China, the US, China, Canada, China, the European Union. I mean, could this get much worse before it gets better?
So I think that's a good question. That's something that, we speak a fair bit as well, which, in part is due to why markets were trading on a risk-off manner coming to this week. Obviously we do have that Friday's job report, but really the whole geopolitical backdrop is getting noisier with these tariffs that are being floated and touted right now, but we don't think that necessarily would change. Again, we'll get more clarity around policies, sometime next year as well. But any implementation of tariffs will take some time. In the interim, we will continue to see some of these, supply chain adjustments that we have seen in the last couple of years really continue on as well.
Raisah, we'll leave it there. Thank you so much for making time to chat with us. Raisah Rasid, global market strategist at JPMorgan. Nancy Tengler is with us. She is the CEO and CIO at Laffer Tengler Investments. And Nancy joins us from outside Lake Tahoe in Northern California. Good of you to make time for us. I'm sure it's a vacation for you. And I'm going to throw you a curveball right out of the gate. So these dinner parties that you've been hosting now in the evening, as you sip that great California Chablis, nicely chilled, what are the conversations like around the dinner table?
Well, Doug, I get up at 3:30 in the morning, so no dinner parties for me.
All right. I'm envious. So talk to me about what you're seeing overall in the overall strength or weakness of the American economy, depending on how you view it.
Yeah, well, it's certainly filled with cross currents, isn't it? I think what we can all agree on is that manufacturing is in a recession and it has been in contraction for almost 2 years. That is not important from an overall GDP standpoint. As a percentage of GDP, manufacturing is 4 to 5%, but the multiplier effect is very important. And so we're watching, of course, like everyone else is, the ISM manufacturing. But I think the biggest disappointment this last week was that prices paid went up. And so, that doesn't bode well for inflation, nor do rising shelter costs, which we're starting to see. There was a headline in the Wall Street Journal today that said real estate investors bet on higher apartment rents. That is not good for CPI. So that's on the one side. The other side is consumer confidence actually inched up. Wall Street Journal survey, UMich Conference Board shows it drifting back up. And then earnings were pretty fantastic this last quarter at about 12.5%, with revenues growing at over 5, and margins at near a historic high. So there's a lot to like. There's a lot to worry about, as is often the case. And so we continue to pay attention to those things, and then hope that the Fed makes the right decision.
Yeah, maybe it's not just about the Fed, because we're in election season now, about 2 months away. And I was struck by some research coming out of Goldman Sachs, the firm's team of economists, kind of gaming out the potential economic implications of either a Republican or Democratic victory. And these economists at Goldman were saying that U.S. GDP faces a hit if Donald Trump were to win. On the other hand, should Vice President Kamala Harris win, and then you're looking at the possibility of Democratic control of both chambers in Congress. Goldman's team says that new spending, expanded middle-income tax credits, maybe that would offer a boost to GDP growth. Is that the way you see the potential outcome of this election?
Doug, I think it's a little bit too early to tell. I mean, what I do remember on the eve of the 2016 election or after the 2016 election, the consensus was that energy stocks would do well, that technology stocks would do poorly, and financials would do well in an environment of lower regulatory constraints. What we ended up seeing in the last Trump administration was energy was down 40+%. Now, some of that was certainly skewed by COVID, but financials were up 40-something%, and technology, I think it was 44, and technology was up like 120% during his tenure. So beware of some of the prognostications, because we just don't know. I mean, the campaign rhetoric often does not line up with how candidates govern. So I think you have to be careful. The market will get it right, but I think it's a little bit too soon. I think we get volatility for the next few weeks, and then the market will start discounting the election, and then you'll be able to sort of see some trends. But by the way, they're both big spenders, and I think the spending has got to moderate. We have a $34 trillion, it's probably $35 trillion while we've been talking deficit and or debt, and we've really got to pay attention to that, because it's over 130% of GDP.
Well, you mentioned volatility, and I'm wondering how you view the volatility that we have seen in some of these technology stocks lately, particularly the semiconductors.
Yeah. Well, we were trimming back all of our technology in early July. And then as we entered the third tech summer swoon, we had one in 2022, 2023, and now this year, we were actually selectively adding to names. So we initiated a position in AMD. We think they're a long-term winner, even if all they get is the table scraps from NVIDIA. We added to our Dell holdings, and we added to NVIDIA, and did so again this morning.
Can you give me a sense, anecdotally? I know you're normally in Scottsdale, Arizona. The CHIPS and Science Act and some of the spending that's been taking place to create these chip manufacturing facilities, many of which are in Arizona. How has that impacted the local economy?
So I think it's helped housing to a great extent. I do think, the economy there is pretty robust. Real estate prices have come in somewhat, but remain still in an expansionary, remain expansionary. But I think, there have been a lot of fits and starts. And Intel, for example, has not yet seen the money and may have to scrap their plant. But Taiwan Semi's plants are moving forward. The construction is robust. And I think it will continue to benefit the economy, because what you're getting now, too, is other companies moving into, Google's got some server farms going in, and there's a lot of activity. When I moved there, it was kind of a trust fund town, and now it's really legitimately a business town. And so real estate prices have really skyrocketed over the last 5 to 7 years. Mm-hmm. You can even argue 10 years after, they hit bottom. And we are seeing, the bad parts of growth, which is traffic, congestion, some air quality problems. We'll
leave it there. Nancy, always a pleasure. Thanks so much. Nancy Tengler from Laffer Tengler Investments joining here on Daybreak Asia. Eddy Loh, he is the Chief Investment Officer at Maybank Group Wealth Management, on the line from Singapore. Eddy, good of you to make time to chat with us. I hope you're doing well. We're bracing ourselves for a rate cut later in the month. The question now is whether the Fed is going to cut by 25 basis points or by 50. Do you have a sense of this?
Right, morning. From Singapore, we are actually currently penciling in the Fed to cut rates by 50 basis points in 2024, with a 25 in September, followed by another one in the fourth quarter. So not likely to see a 50 basis point rate cut in September. Having said that, I think a lot depends on how the jobs data is going to pan out. So we do not rule out more aggressive Fed easing down in subsequent months should actually job data deteriorate more than expected.
So one of the things that I was looking at today is the move lower in Treasury yields. It's stunning, actually. The U.S. Treasury curve is essentially flat right now, a 2 and a 10 each at 3.76%. We saw some dollar weakness in New York trading. Is this something now that is pretty much at a tipping point where the dollar is going to remain weak going forward against the majors, and perhaps you're going to see currencies like the yen clearly that will continue to strengthen?
Right. I think, we have actually been calling, for the Treasury yields to trend below 4% since the beginning of this year, and that has worked well for us. But having said that, at this juncture, if you look at market pricing, market is actually pricing in 100 basis point of rate cut this year. We thought that's a bit too aggressive. Right. So, in the near term, we could actually see some choppiness in the Treasury yields. And dollar actually looks a bit oversold in the near term. So not surprised to see a rebound in the short term, although I would say that upside is capped. So in the short term, despite the fact that there could be a short-term bounce in the dollar, we would be sellers, because we think that the dollar should actually soften in the medium term against Asian currencies, including the yen.
Speaking of the yen, I mean, we were really strong in New York, trading up about 1.2% against the greenback, and then came data from Japan that workers' real wages moving up in July for a second consecutive month. Does this really keep a lot of pressure on the BOJ to hike before the end of the year?
We think so in some ways, because if you look at, apart from the wages, if you look at Tokyo's August CPI data that just came out yesterday, CPI ex-food, it was actually 2.4% year on year, higher than expected. So we think that the Bank of Japan is likely that there's a good chance that the Bank of Japan could hike another time, sometime in fourth quarter. Having said that, the pace of tightening from the Bank of Japan will still be measured because they need to balance the need to support growth. But, given the fact that BOJ is hiking, the Fed is easing, we think that the dollar yen should head towards 140 by the end of this year.
Well, let's talk a little bit about China. I'm curious to get your take. I mean, things have been so disappointing when you look at some of the data, particularly the PMI reports that we had in the last week. And I'm wondering whether or not you are confident that we're going to see something meaningful happen in terms of policy from the central government. I mean, it seems as though there's been so much resistance on the part of Beijing to do more. And I understand, in theory, why they are being so deliberately slow in doling out more stimulus. But it seems like there's no way to turn this weak sentiment reading that we're constantly talking about, whether it's the consumer or, in the case of a number of businesses, more weak sentiment. No way to turn that around unless you get a lot more from the government. Is that accurate, or am I wrong in that?
Yeah, well, in some ways, we were also a bit disappointed by the lack of significant big steps to really revigorate the confidence, be it in the consumer space or is it the corporate space. So if you look at China's growth momentum, it has been sluggish. Second quarter earnings were also unremarkable. And in terms of stock markets, valuation is inexpensive, but unlikely to stage a meaningful rebound unless we see really big moves from the Chinese government. But at this juncture, if you look at the economy, it's sluggish, but it's not collapsing. So unless things get really bad, we unlikely to see a big move from the Chinese government in the near term.
So how are you exposed to China right now? Do you have exposure, let's say, in some of these medium-sized businesses?
No, I think at this juncture, we are a little bit more cautious towards really consumer-related sectors because of the very weak sentiment and the retail sales numbers also were not great. Instead, I think we will prefer to be positioned defensively towards, some of the dividend-yielding sectors, SOEs, like, for example, the energy and telcos. You sort of like share prices will be supported by the dividend yield that is actually still pretty attractive at this juncture.
Well, you mentioned energy. Crude oil in New York yesterday, I think we fell to a 9-month low. There's a lot of concern about soft demand globally. That's a China story, and the risk that maybe OPEC Plus will raise output next month. I'm seeing WTI right now in the electronic session a little positive, but we're sub $70 a barrel. Are you optimistic that energy is the right play here?
Well, I think that if you look at energy play, no doubt, yes, weak demand outlook is particularly from China that's weighing on prices. But having said that, OPEC plus supply, I think that remains a question because I think if you look at the latest comments, OPEC is actually talking about maybe perhaps they are considering not to increase supply in the coming months, given the recent retreat in prices, plus the fact that we still have lingering geopolitical uncertainty in the Middle East. I think that's somewhat underpriced. So we think that at this juncture, oil prices could actually find support at around the $70 per barrel at this juncture.
Eddy, when you talk to clients, what are they sharing with you in terms of their concerns and maybe their resistance to taking on risk at this point in time?
I think one of the key things here is that markets have actually, despite the recent choppiness, equity markets have actually done very, really well this year, especially in the US. And valuations for S&P 500 is a notch, one standard deviation above the historical mean. So there are some reluctance to actually chase the market. But what we are saying here is that, yes, I think no doubt it is actually, we are going into a very tricky transition period where the Fed is expected to transit to a rate cut cycle, and the US is going to transit to a new leadership by November. Having said that, soft landing in US is going to be supportive for risk assets in the medium term. So I think there are still opportunities, particularly beyond the mega cap or AI stocks.
Eddy, we'll leave it there. Pleasure to have the chance to spend time and discussing what markets are doing these days and to get your perspective. Eddy Lowe, the Chief Investment Officer at Maybank Group Wealth Management. This has been the Bloomberg Daybreak Asia podcast, bringing you the stories making news and moving markets in the Asia Pacific. Visit the Bloomberg Podcast channel on YouTube to get more episodes of this and other shows from Bloomberg. Subscribe to the podcast on Apple, Spotify, or anywhere else you listen, and always on Bloomberg Radio, the Bloomberg Terminal, and the Bloomberg Business app.